Okay, so now we'll look at the accounting for tax consolidated groups. So the relevant pronouncement will be UIG 1052, which requires subsidiaries to record their tax effect accounting entries, regardless of whether a tax funding agreement is in place. So we'll discuss what that is. So what that means is that each and every entity in your tax consolidated group should be preparing their own tax effect accounting calculation. You then work out where the current and deferred tax balances needs to sit. So under UIG 1052, when you're doing the calculations for the head company, it will recognize its own current tax liability. It will recognize its own deferred tax asset and liability for its temporary differences, and it will recognize its own deferred tax asset for its tax losses and tax credit. When you come to perform a calculation for a subsidiary member, the subsidiary will initially calculate and recognize its current tax liability, but UIG 1052 requires that amount to be immediately assumed by the head company. So the current tax liability initially recognized is moved to the head company. The same with deferred tax asset for losses and credit. Initially, the subsidiary will recognize it in its balance sheet, but then instead it needs to be moved to the head company, as it is immediately assumed by the head company because under the tax consolidation rules, the tax losses flow immediately to the head company of the tax consolidated group. The only balance that stays in the subsidiary entity is the deferred tax asset and liability on its balance sheet items, its temporary differences, because the balance sheet belongs to the subsidiary member. Now, the question then is, your subsidiary has a current tax liability sitting on its balance sheet. It needs to debit that current tax liability to zero. The question then is, what does it need to credit? So the answer is, if you have a tax funding agreement in place, then the credit goes against the intercompany loan account. If you don't have a tax funding agreement in place, then the credit goes to the share capital account, a fictitious equity account. In relation to deferred tax assets on losses and credits, the other side of the entry is a dividend payment. So that confuses the accounting, and therefore we strongly recommend that when you enter into a tax consolidation regime, to put in place a tax funding agreement. So when you perform the tax calculation for members of your group, UIG 1052 provides 3 examples of the approach which you can take. So the first one is the standalone taxpayer approach, which requires you to assume that the subsidiary is not part of the tax consolidated group. And therefore, what that means is that if there's a sale transaction to another member of the tax consolidated group, that sale is tax effected. A variation of that is a separate taxpayer within the group approach. And basically what that says is, yes, do your calculation as though you're not part of the tax consolidated group, but you do recognize that transactions with members of the group are not for tax purposes. So if you have a sale to another member of the group, you can ignore that sale. That is not tax, that sale. Our preference is to use the standalone taxpayer approach. Therefore, your tax expense more accurately reflect the economic position of that entity. The final group allocation approach is to allocate the balances in a fair and reasonable manner, and really you have to use 1 or 2 approach at the top, which we discussed. Okay, so let's look at a simple example. Firstly, assume that head company does not have anything, no P&L within it. It is a simple dormant holding company. The subsidiary has land and building worth 10 million. And let's say accounting depreciation is 2 million and tax depreciation is 3 million. So accounting depreciation is less than tax depreciation. So this will reverse as more taxes in the future. So you have a deferred tax liability as a result of that. The profit of the subsidiary is 100,000. Okay, again, assume the head company has nothing in it. So what you need to do is firstly calculate your statement of taxable income. You start with a profit of 100,000, accounting depreciation of 2 million, and tax depreciation of 3 million. So tax is more than accounting, and therefore there will be a DTL on this entry. We have a taxable loss of 900,000. And let's say the subsidiary assesses that it can recognize the losses and records a DTA of 270,000. So the journal entries that the subco will need to post is to recognize the deferred tax liability on the plant and equipment. So the DTL is 300,000, paying 30% of the 1 million difference between accounting and tax depreciation. So the entry is to credit deferred tax liability and debit deferred tax expense of 300,000. The subsidiary also has a tax loss and recognize the deferred tax asset of 270,000. So you recall there's a tax loss of 900,000. The 30% of that is 270,000. So the journal entry is to debit deferred tax asset by 270,000 and credit deferred tax expense by 270,000. Okay. Now, I note here that if the subsidiary assess that it's not probable that you'll use those losses, then it would not recognize any deferred tax asset and there'll be nothing to be assumed by the head company. Now, as a subsidiary has recognized the deferred tax asset on the losses, it is immediately assumed by the head company. So it credits the deferred tax asset account by 270,000, and assuming that a tax funding agreement is in place, it would debit the intercompany loan by 270,000. The head company has assumed the deferred tax asset, so it needs to debit the deferred tax asset by 270,000. The credit entry is to credit the intercompany loan with the subsidiary company by 270,000.